anyway, as they're working on this thing. So capital budgeting, it can be brought in two phases. They can bring one, the question can come and they ask you to compute the net present value. Now with net present value, you're going to use it with different items. If they say, for example, the question wants you to find the profitability index, obviously they want you to find the NPV first, because you cannot advise on profitability index minus computing for NPV. So the examiner actually wants NPV, but he brings it in a different set. He can say, I want you to find internal rate of return, but obviously what comes up there is your computation for net present value. It's very, very important. And in the other way, it's just me, or the volume is down. My volume is down. I don't know. Let me try and see if. Can you guys hear me? If my volume is down, you can let me know.
We can hear you loud and clear, sir.
Okay, I hope now it is going to be fine. So I was saying that you have to be very careful with question one, because the most important area is capital budgeting of this paper. And you should never even think of going there without knowing capital budgeting. When we're studying capital budgeting, we say it is divided into sections or areas. One, you look at the appraisal methods as the calculation part of it, and then you look at the other small components, the small theory component. Now, with the appraisal methods, they were divided into those that take into consideration the time value of money, which we call the discounted cash flow, and those that don't take into consideration time value of money, that we called the non-discounted cash flow methods. Now, the examiner is much interested in the discounted cash flow methods. That includes the net present value, the internal rate of return, and the profitability index. Now, the examiner in that question, most cases fix you about how to find the sales or revenue and how to find the direct costs or variable costs. Most of the tricky areas are there. One, he may bring the sales in form of percentages. You're not going to have actual sales in values, but probably he's giving you one figure where you will compute. Or he can bring variable costs in form of percentages. And he says variable cost is going to be a percentage of sale, and you will need first find the sales. Now, in the figure for sales, he likes speaking about the inflation. He's going to give you a real cash flow, and he may want you to have a nominal cash flow. A real cash flow, we mean, those of you who were in our class, cash flows that where they have not applied what? Inflation. Real cash flow. And in an exam, you will see, say, real, my cash flows are real. It means they have not yet applied what? Inflation. Two, he can bring when the cash flows are nominal, and the nominal cash flows, all the cash flows that from which the inflation has been applied, is what we use in computing for net present value. Now, he may also trick you about the cost of capital. Sometimes the question can come and it needs you to first compute the weighted average cost of capital using the dividend valuation model. And thereafter, you use the cost of capital that you have got in part A to evaluate projects in part what? In part B. That is if he decides to make it wide enough. So, capital budgeting, please don't enter that exam when you have not mastered it. And I said, the key areas you look at here is the net present value, NPV. You look at the internal rate of return, the computation for that, and the profitability index. He can play with these. And the areas you look at here is how you determine the revenue, given different percentages, how you determine the variable cost. And sometimes they can bring you fixed costs that are incremental. I want you to understand, for the purposes of evaluating a project, if you're given fixed costs, you take incremental fixed costs. Fixed costs that remain the same or constant, don't consider them unless they have not yet been incurred and they are incremental in nature. Now, the other area you have to look at is the area of tax saving under capital budgeting. How would you compute the tax savings, and how would you treat tax in the question? And finally, working capital. Working capital. So you need to have a small brainer, if not an in-depth knowledge. And by now we should have practiced enough. I'm just going to use 15 minutes to just take you through, but then we go into our session. So now there is another question that the examiner is becoming interested in. The question of equivalent annual cost. This one also comes in the form of capital budget, and he has actually brought it like 2 or 3 times recently, where you are given, for example, assets that have different useful life. You have asset A, and it has useful life of 3 years. You have asset B, and asset B has useful life of 4 years. The question may come and they want you to evaluate the two. The moment you see a question and you have 2 different useful lives on the same question, and they want you to evaluate, you are going to use equivalent annual cost. But don't forget, equivalent annual cost or benefit is also an application of net present value, because you just need to compute net present value for each options, and then what you get, the net present value, you will divide it by the annuity factor that has been given to you in the question to get the equivalent annual cost or benefit. If you are evaluating costs, the one that gives you the lowest is what we recommend management to do what? To take. Remember, as a student, you do not make decisions for management, you recommend. You have to be very careful when you are writing this exam. The language matters. And most importantly, you need to get used to something called academic writing. It doesn't matter whether the question has asked you for the advantages of net present value. You need to first speak about it. Give it a brief introduction, give the advantage, and conclude. For every theory number you do, you must give an introduction, you must give the body what you are answering, and you must conclude. And you conclude in reference to the question that has been given to you. One of the things that the examiner noted is that people do not contextualize the question. When you are writing or answering an exam, you don't refer to the scenario in the question. But these are scenario questions and they are case studies. For the matter of fact, if you do a question and you do not recommend, you have not answered the question. Because most questions say advise. So if you just calculate and you do not advise, you are not going to get the what? The marks, because you have not answered the question. Some of you may think that the examiner will have mercy on you because you have calculated. That's not how things work here in this paper. You need to use the calculation to advise management. Okay? So you have to be very careful. If the question does not come from the capital budgeting, it is going to come from 2, cost of capital. Cost of capital, by the way, sometimes they mix. They can bring, one version is capital budgeting, the other version is cost of what? Of capital. You know that these are the 70 or 80% of question 1 comes from this area. Now here, these are things you need to be acquainted with. Before you enter, you need to understand, most times they are going to ask you to find the weighted average cost of capital work. So they may either ask you to find using the current values or what we call net book values. Net book values means that you are going to use the figures which are being given to you in the balance sheet. or in your statement in the question. That's what you use to compute the weighted average cost of capital using book values. The only difference here is the values that you are going to use under the net book values. The values are book values. You don't need to recompute them. You use the ones that have been given to you in an exam. And then also, the other difference is if you have other components of equity like retained earnings, and you also have, let's say, share capital. Despite the fact that both of these are going to have the same cost of equity will apply on them, but you will have to find the proportion and the weight for each. It doesn't matter if they are all equity components, but you have to find for each. You will find for this, but they will have the same cost of equity. And then you'll find for share capital as well. That only applies when you are told to use book what? Book values. If they are market values, then you just have to use the market price per share that is going to be given to you in the additional information and multiply with the number of what? Of shares. I think that is one of the things that you have to be careful with. Then they may ask you to find the work using market what? Market values. You may find work using market values. Market values, where is the interest of the examiner? They want to test your understanding of how, whether you learned how to find the cost of what? Cost of equity. Cost of equity, here most cases they use dividend valuation model. Dividend valuation model. By the way, sometimes dividend valuation model is the gentleman who designed it is called Gordon. So when they ask you Gordon's model, don't say, but what is this now? I don't know this Gordon thing. This is the same guy who came up with this. He came up with different versions of this, but when the examiner says use Gordon model, fine, it means that you have to use the dividend valuation model. Okay? Don't forget that the cost of equity is equal to, if you do not have the future, ideally it will be equal to the future dividend over the market price per share. If you have any flotation costs, you less them off from here, okay, plus the growth rate, or G. This is how you find the cost of equity using the dividend valuation model. If you do not have the future dividend, then, by the way, if I'm going fast, you let me know. I just want to make sure that we utilize the 30 minutes to first of all get a picture of how the question is going to look like, or the paper is going to look like. Then we go back to our revision session. But if I'm going fast, you let me know. This is just a brief. It's a brief for you to. Yes, please. Yes, for book values, you'll use the values that have been given to you in a. No, for book values, you cannot find a value using a market value. You use that's the reason why it is called book value. You use the book value that have been given to you in an exam. Yes, you only find the cost, and then you multiply by the values that have been given to you. General reserves are part of equity component. You also treat it as equity, but you don't add it. Find its proportion separate. Then if you have share capital as well, find it. Then even if you have retained earnings, find it. Sometimes it's the same. Then bring the equity and add them together. If it is market values, you just need one equity company. Doesn't matter whether you have retained earnings or reserves. You just get the market price of a share and multiply it with the number of shares to get the new market value. You don't need to now separate them. You understand? Yes, it is the same because it is all shareholders' money. Yes, you use the same. Okay, so if you are going to find the cost of equity when you don't have the future dividend, but you have the current dividend, you would compound the future dividend, DO into over market price per share. If you have flotation costs, you remove them, plus G. That's how you would find the cost of equity. So, but the trick may be here, actually, in most questions of cost of capital, it is about weighted average cost of capital. It's about if you know how to compute the cost of equity. It is the one that normally carries the most marks. But now, he may probably trick you about the values, and he gives you in form of premiums and what? And discounts. That is all he can do. He can say maybe that the market price per share is trading at a premium of 10%. When they say premium, by the way, for you to get the value that they want, you are going to get the per value plus that premium that they are giving you to get the new market value. If it is the discount, you less off. You get what I'm saying? So he can just trick you about that, but the rest is going to be very simple. The market values are always given. You get the number of shares or the number of debt stock or loan stock times the market value that has been given to you in an exam. But you need to understand that is how we get cost of equity. Then you get the value of equity. Then if it comes to preference share, how we get cost of preference share? Cost of preference share, if it is irredeemable, in any case, it would be equal to the dividend, ex-div, the dividend on the preference share over the market price of a preference share times 100. That's how you get the cost of a preference share. So never forget this. That's how you get. Maybe someone may ask, but Ivan, how do you get the dividends? The dividends on a preference share, it will be equal to the coupon rate that has been given to you times the per value. Coupon rate, what do you mean? Is this a debt? No. Preference shares also have their rates. So that percentage that normally begins is their rate, coupon rate. So you would get it if it was, let's say, 15% preference share. If it was 15% preference share, you would get 15% times the per value. It is always times the per what? Per value. Some of you make mistakes of multiplying it with the market value. Please don't. If you're getting dividend, it is on the per what? Per value. Now, if someone may ask, but Ivan, what if they ask me to find the cost of a preference share that is redeemable? How would you find it? You can use what? Internal rate of return. Oh, there's actually a formula. Some of you may have seen it. Cost of a preference share is equal to the D, which is the dividend, plus the redemption value minus this is the redemption value minus the market value. In case there is a flotation costs, you would less them off from here. In case they are there. If they are not, then don't. Normally they're given in percentage over the N, which is number of years. And this all over the redemption value minus the market, plus the market value. If there is a flotation cost, you remove it from the market value over 2. This is also another formula of finding the cost of preference share. Some of you who don't want to go through by the way, you can as well use this same with the cost of debt that is redeemable. But the only difference is now, instead of this being a dividend, the other way it will be an interest. We just less of tax on that interest. but it will give you the same thing. So those of you who have used this before, it's okay. If you have not, use the internal rate of what? Of return. But it will give you the same. Because guess what? It is very easy. You will have the redemption value. You will have it. There is a formula for computing what? What is that? There is a formula. Yes, there is a formula. There is a formula. But it is people, by the way. They can put it there. They can. Yes, they can. They can. But you can use the internal rate of return. But I'm saying, do you know how simple this is? Once you get, because it's dividend plus redemption value, you will have this redemption value. Redemption value is this amount that is going, they say redeem that par, so you use the par. This is the market value. This is the market value. These are the number of years. Number of years. So what is the problem there? You get, you just feed in the figures. The 1 minus f is when you have flotation costs. But if you don't have flotation costs, don't put it there. And you get the cost of preference. Yes.
Excuse me.
Yes,
market
please.
value the same as market price?
Yes, market value is the same as the market price. In case the examiner is silent, the value, I have not read that. What is this saying? Let me see.
Excuse me, sir.
Yes.
Sir, you've talked about the flotation costs. If we are using the IRR, how do we use it?
Now, the flotation cost, I said, in case it is given to you. Because you see, if they are preference shares, they may issue them with costs. You know very well when you are issuing shares, sometimes they have flotation costs. Flotation cost means because you don't just go to the market, you pay some money before you go and issue your shares there. In case the question brings them, that's how you remove them. But if it is a debt and there is no flotation cost, then don't put them there. You only bring it if it is there. And if it is given in percentage form, 5%. So you just get the market value into 1 minus 0.05 if it is 5%. Period. That's all. And it is as simple as that. And you'll get your cost of preference share if it is redeemable, a preference share that is redeemable. So do we charge tax on the interest? Yes. If it is a debt instrument, the D will become I or interest, and you remove tax on it. Yes. Yes. If the question has not said anything about tax, you can ignore or you can make an assumption. You only make an assumption if it is a debt. If it is a debt and it is a bond and the question is silent about tax, you can say, assuming there is no tax or assuming there is tax, you don't just proceed. You make an what? By the way, when you are doing financial management, and I think let me also tell you, one of the reasons why people fail this paper, people think this is a calculation paper. You know, when you go with that mentality that this is a calculation paper, you are going to fail it. This is a strategic advisory paper, advisory on a board level. If you are the board member, and then I get a consultant, because in most questions you are a consultant, they ask you as a consultant, advise us. Now, let me tell you what is funny. The examiner assumes he's a client actually when they are marking you. So the question has come and they want you to advise this company whether they should take something or not. And you just calculate things and leave them there. Do you think they will give you marks? They cannot, because you have not advised. The guy was very clear, advise me. By the way, they assume they don't know. You get? Now for you have computed things and then you left them there and say, maybe you will give me some marks. Here they do not. Maybe in accounting they do. Here they don't give free marks. You must complete a question and answer and advise. You understand? Because if you don't, then you have not what? Answered. And I told you, you need to practice what we call academic writing. It does not matter whether the question says disadvantage of this. disadvantage of payback. You don't just come and say disadvantage of payback. Talk about it. Payback is this and this and this. These are some of the advantages of it. Then you conclude if there is an advantage you have picked interest in. What if you are caught by time and haven't finished the calculation? You have not answered. By the way, some of you know, you need to know that time is also part of the exam. You know that time is part of the exam. Because in real life, and let me tell you why it is part of the exam. In real life decisions, you will never have time. You know that. All human beings, we are limited by what? By time. Your client comes, they want you to make a decision in 1 day. Are you going to say now, give me more hours? You cannot be caught by time. You need to manage your time properly. Is that okay? Manage time what? Properly. By the way, you need to be very careful. And this thing you also need to understand. You need to understand one thing. Please get this. You know when they say, and I've seen this from very many students when they fail this paper. Someone will come and tell Ivan, I have failed this paper, but I don't know how. I knew everything in this paper. Now the paper said, attempt how many questions? It said attempt 4 questions. For you, attempted 3. It does not matter whether you passed all of them. You did not read the instruction. You would rather go and write nothing, but write something there to show that you did what? You attempted. If you do not attempt anything on that question, your chances of passing may be low. The instruction is what? Here they have said attempt 4 questions. You must attempt those 4 questions. You'd rather go and write some small theory on it or do wrong calculations, but you have attempted. Because if you do not, then you have not read the what? The instruction. Is that okay? Good. Now, in case the question wants you to find the internal rate, the cost of preferred share that is redeemable, you may use the formula or you may use the IRR, but you don't put tax there. Good. Now, of course, the market value of a preferred share will remain the same. You first find the number of preferred shares by getting the value in the paper, in the balance sheet. Divide it by the per value, not market value. Get the shares, then multiply those shares with the market value that have given what? They have given you. That's how you find the market value. So if the formula wants you to find the cost of equity using market value, you must find a cost of each and a value of what? Of each, except for what? For term loans. Term loans are fixed. They are the only ones where you don't find the value. You don't find the value of a term loan, but you find its cost. The cost is always given to you as a coupon interest, but you have to remove what? Tax. Okay? So, I think there is no much thing to learn about the cost of the weighted average cost of capital, other than now you knowing if they want to find the cost of debt, any debt instrument that is redeemable, you use internal rate of what? Return. Never forget that. You use internal rate of return to find the cost of a redeemable debt instrument. Never forget tax. Never forget what? Never forget tax. Okay? Now, you are going to put it in the formula, find the weighted average cost of capital. That's a common number. They may ask you some theory on sources of capital. They may actually mix it with Islamic finance. That is one theory that never misses an exam. Why should you go in that paper without knowing Islamic finance? Why? You should never enter this exam if you have not read the theory on international markets and capital markets. Don't bother. Don't go in that paper if you want to do theory, if you have not read Islamic finance. And finally, when we say international market, don't forget we also incorporate in market efficiency. You've ever heard of market efficiency? Theory of market efficiency? semi-strong, strong, the forms of market efficiency. You've heard of those: Uganda Capital Markets Authority, the Uganda Securities Exchange, the roles, the advantages, the disadvantages, the main market segments, alternative, the requirements for each. Then the international bonds, international bond instruments, the euro bond, euro equity, euro currency. Please don't go in that paper when you don't know that theory. At least for the last 4 years, it has been coming in each paper. That and Islamic finance in each paper. And by the way, a person who at least attempts one theory number in this paper is on a higher advantage of passing it. Because you need to know that this paper is 55% theory. This paper is 55% theory, and it is 45% calculations. Be aware. By the way, you should be very careful not to show the examiner that for you only know calculations. So when you are attempting questions, you are only attempting calculation inside, but you are leaving out the theory. Once he spots that, does not matter whether you have passed everything. And I'm telling you that's why people fail this paper. It's not because they don't know. It's not because they don't know. They just don't know what the examiner wants. And the examiner is always very clear. When you meet them, the same message they say, even when you read their report. You get what I'm saying? 55% theory. If time has caught you, go in 2020, from 2020 up to date, and look at the theory that has been brought about in every paper. At least read that. If time has now caught you and you're like, Ivan Miyaya, I've not been reading this thing, I don't know where to start from, go and do that. You know what I'm saying? Okay. Now, there is a question they have taken long without bringing, and I think, I don't know, but let's find time and go through it. It's something called cash budgets. They used to come those days. Cash budgets. These things used to come those days, but they have taken, come again? They take a lot of time, but it can be brought as a compulsory number. That's why I'm saying questions that can be brought as a compulsory number, you have to be very careful with them. Not to go when you don't know. Yes. So find time and go at least practice 1 or 2 numbers of yes, of cash what? Of cash budget. Yes. Now, the other one, and finally on the compulsory number, is the number of ratio analysis. If there is anyone in this on this call who has not or who doesn't know how ratio analysis works, please, you are not ready for this exam. You need to know ratio analysis properly. And by the way, in ratio analysis, the marks are not in computing the ratios, but in how you analyze the ratios. Some of you waste a lot of time on computing ratios. If the examiner has not specified how many ratios you compute, you are going to analyze this company at least in 4 categories. You will analyze the liquidity of this company first. You may analyze the liquidity of this company first. 2, you're going to analyze the returns, the profitability and return. Profitability and return. You know very well that under liquidity, at least don't miss the current ratio. And the quick what? Quick ratio. Is ratio analysis the same as financial analysis? Yes. It's financial analysis. And it is divided into 2. There is this one, a normal trend one, and there is common size analysis. So you have to be very careful which one they have asked. You get what I'm saying? Some of you get excited, you don't know which one they have asked. There are two. There's common size and there is this normal trend and ratio analysis. When you are analyzing, you don't make a comment every time you compute a ratio. You have not yet seen. You need first compute all of them to have a picture of the performance of this company. We are going to try a number here. You will see another way they can bring ratio analysis, by the way. It was brought in the last sitting. We are going to do a number today. So you will have to compute on profitability and return. You have to compute loss at least. Then there is profitability margin ratios, gross profit margin, net profit margin. Those profit margin what? Profit margin ratios. Because these ones are going to tell you how profitable the company is. The liquidity is going to tell you how liquid the company is. And you have enough money to pay your liabilities. Or you don't have. You may be experiencing liquidity, but you are making profits. You get what I'm saying? It means if you are experiencing liquidity and you are making profits, what is the problem? You're over giving out what? Sales on what? On credit, and you have too much of your things. You have too much of your money in receivables and stock. You have a lot of money tied up. That's what it means. The company may have liquidity problems and profitability problems. But that doesn't mean it does not have capacity to get loans. Then you compute the value. You analyze using the solvency ratios. Solvency ratios. They will show you the solvency of the company. Do they now have the capacity to have future loans? They may be experiencing issues, but their solvency ratios are good. You would advise them actually go and get the loans. Why are you experiencing liquidity issues yet you can get loans? Because you have capacity. You can compute the operational average or average financial average ratios. It could be a financial average. It could be debt to equity ratio. You understand? At least you compute 2 if they have not specified. Because why are you computing more than 2? What are you showing? You're not going to complete the exam. And then finally, you can analyze it on investor. Sometimes I call it investor return or investment ratios. These ones you want to know if the company is liquid and it is profitable and it has capacity to borrow, can it pay back the shareholders? You want to when the shareholders see them, can they be happy to invest in this company? By the way, company may be experiencing liquidity problems, but its profitability is good and the solvency is good. So probably there's something wrong, but the shareholders, it doesn't stop shareholders from what? Investing there. So here you may look at the ROI, return on investment. You may look at there are very many ratios here, dividend yield ratios. Those investment ratios. You may look at EPS, earning per share, and so on and so forth. So if a number comes and it's on ratio analysis, you need to know how to compute these ratios, and not only know how to compute them, but you can give an analysis. You can analyze, but remember you cannot analyze unless you have computed all of them and it gives you now a bigger picture. You understand? Great. Now, a question may come and they want ratio analysis, but common size. You know common size? Common size is simple. Common size analysis is very simple. You're going to have 2 things. You're going to have they're going to give you profit or loss figures for maybe both years, and they're going to give you the balance sheet figures. Balance sheet figures. So, if you have profit or loss and balance sheet figures, how do you analyze it? For profit or loss, everything is going to be a percentage of what? Of sales. Apart from the sales over sales, which will give you 100. Everything else is going to be of a percentage of sales. If it is gross profit over sales times 100. If it is the administrative cost over sales, like everything is going to be over sales. So you have those percentages for both years. When it comes to the balance sheet, everything is going to be out of total assets. You still analyze everything out of total what? Total assets. You just compare the trend. If it has increased, if it has reduced, and comment about it. Now, it takes us to the other way they can bring this ratio analysis number, which they brought last sitting, and I want you to open that paper. Open the paper of question. Let me see. Open this paper, August 2025. I think it was question. It was question 4. It was question 4. Let's do that paper. In just 20 minutes, we can do and then analyze it, and we see in which other way they can bring this. And I think the examiner started bringing it recently. He was not bringing it. It means he's speaking what? He's speaking interest. Now, this question, the examiner wanted you to discuss the indicators of financial distress that stakeholders should monitor, assess the risk of insolvency or bankruptcy in a company. When you see a question asking you about bankruptcy and it has ratio in it, they want you to use Altman's Z-score to analyze whether this company is going into bankruptcy or it is still a going concern. When they say financial distress, what do they mean? It is a situation where you don't have money. You know, some of you have a common term, I'm broke. Now, if a company is broke, you know there's a difference between being poor and being what? Broke. Now, it's a situation where the company is broke. One, they don't have money to pay their salaries. Staff are still demanding salaries. They are even demanding areas as back as 3 months or 4 months. Suppliers are complaining. You are not paying them their money. You are having fights with them. They are even considering taking you to court. URA is on your head. You are not paying taxes. Assessments are like assessments. Who else? You are not paying your bills, even electricity, food. Sometimes staff miss out on food. Like, it's a situation where you are distressed. By the way, they may ask you what causes it. As simple as that. What makes you to be broke even when you earn a salary? Poor cash management. You don't know how to manage your cash. Uncontrolled growth. Small money, and you are in Ghana looking for the car. Small salary increment, and you are looking for the car and a house in Mnyonyo. Uncontrolled what? Growth. Like you don't need to know a lot. Think of it in that perspective. What makes me go broke even when I have what? Money. Now, think of it in a company perspective. What makes a company go broke even when they are making money? Yes, they can have tied up capital, all that. So here they asked you, discuss the indicators of financial distress that stakeholders should monitor. What do you think are the indicators? Yes, failures to meet your short-term what? You are having litigations all the time. You are here and there are notices to sue. Those are indicators. You are not, you no longer produce at your capacity. What is the problem? Why are you not? The clients are ever reminding you, please my order, please my order. The orders are not what? Coming. Why? That's an indicator. We are not saying that you are there yet, but it's an indicator. In your company, the staff keep changing. The longest staff there has only served for 1 year. There is an issue. Those are the indicators they were what? Asking about. Now, part 2. They asked you to use Outerman's Z score to evaluate LDC's risk of bankruptcy from investors' perspective and comment on the score obtained in both 2022 and 2023. That is the other way they can bring this ratio number, and they brought it. 10 what? 10 marks. 10 marks plus the 5. How many marks? 15 marks. Let's see how to get this up. Now, one thing you need to know about this Outerman Z score, this gentleman here. Now, this guy, first of all, the Outerman Z score is a financial model which we use to predict the likelihood that a company will go bankrupt within the next 1 or 2 years. It was developed by a gentleman called Edward Outerman around 68. And it is widely used in credit analysis, in auditing, in investment decision, because it will tell which company is going to go bankrupt. Outerman did not want to bother people. He came up with a small formula that I can know a company that is going to run bankrupt by my formula. How? So he came up with what we call the Outerman. It's called Outerman Z-score formula. He said, one, my Z or my Z is going to be equal to 1.2, that's a constant, x1 plus 1.4, that's a constant. Come again? Oh, sorry, you can't see the screen. Sorry. You can see now? Guys, can you see the screen? I mean, people who are streaming online, can you see the screen?
Yes, sir. Yes.
Great. So he said, if I have 1.2 x1, it's just his formula. 1.4 x2 plus 3.3 x3 plus 0.6 x4 plus 1.0 x5. Write that formula.
Excuse me, sir. What is that number on X4? Is it 2.6 or 3.6? X4.
X4 is 0.6.
Thank you.
Write it down. So he said, okay, because these numbers, you know them, they are constant. But what about X1? What does it mean? You know Z means Z score, not so. But what about the X's? He said, okay, this X1 is going to be the analysis of working capital. Working capital over the total assets. You're going to just compute that ratio. It's X1. What does it measure? It is going to measure the liquidity and the ability to meet short-term obligations. So it will measure the liquidity and ability of the company to meet short-term obligations. That is going to be X1. It means for you to get X1, you're going to get your working capital. By the way, you know working capital is current assets minus current what? Liabilities. It means you're going to add all the components in that balance sheet of current what? And you less off all the components of current what? Liabilities. The total assets will be given to you. And you get it. You get what I'm saying? So you'll have the liquidity. This one is going to measure the liquidity and the ability of the company to meet its short-term what? Obligation. He said X2 X2 is going to be the retained earnings. The retained earnings over total assets. What does this measure? This one will measure cumulative, this measures cumulative profitability. Cumulative profitability, or how much of profit the company has kept over time. X2 is going to be retained earnings over total assets. And what does it measure? It measures cumulative profitability, or how much of profit the company has kept over time. 2, he said that X3. Am I fast?
Excuse me, sir. Excuse me,
Yes.
sir.
Yes.
A question. Just in case we are
Yes.
not given retained earnings in the information, can we use the reserves to replace the retained earnings?
By the way, you need to understand something. A reserve is a retained earning. These are used interchangeably. When you make profits at the end of the year, what we call net profit or profit after tax. Now, you may decide to pay dividends on them. So when you pay dividend, whatever remains after paying dividend, you take it in what? In reserve. Just that here in Uganda and in Africa, we do not have statutory obligations to have these statutory reserves. But in developed countries and companies that are in countries that are very strict, all companies are required to keep statutory reserves by force. But here I think you can even get all your money and you eat it and go away. It's your company. But in some serious countries, you must have statutory what? They give you a percentage of what you have earned. You must keep it in reserves. So if you do not pay dividends, your reserves are the same as your retained what? They are the same. So if in the question you are not seeing retained earnings, please use the what? The reserves. It means they have been, everything has been reserved. You cannot find a question that has retained earning and reserves. And even if it is there, they both mean the same thing. I think I have not seen it unless it is in accounting where they can now separate them for accounting purposes. But here reserves and retained earnings are the same. I don't know, have I answered you?
Yes, please. Thank you, sir.
Good. So X3, he said, is going to be earnings before interest and tax over total assets C. What does it show? This one shows operating efficiency and the ability to generate profits from the assets. It means that now here by you computing X3, but are you saying that this guy actually picked out a key ratios in each of the other categories for him that he thinks if you have them, you will analyze the 360-degree of the health of the company? You see that he's going ahead to pick just one. So he said, no, here X3. You now see that X3 is on efficiency. It measures the operating efficiency and the ability to generate profits from the assets. And X4, are we done? We done? Okay. So X4 is going to measure the market, it's going to measure the market value of equity, by
By the way, here you have to be very careful. They will give you market value in an exam, either as additional information or somewhere. If they have not given you market value, you will use the per value to be the market value. Okay? So it's going to be market value of equity over the total liabilities. And what are we measuring here? This one is going to measure the leverage and the solvency for private companies. You see that this guy was actually trying to analyze the performance and in different categories. And when you put it in his formula, you're going to actually get. But we are going to see how it works. Finally, X5 is going to be the sales over total assets. And this one will measure, the asset turnover. Kindly scroll up on 3. I told you when I am fast, let me know that Ivan, you're going so fast. Okay? Yes. Yes, X4. Why is it specific on what? On private companies. Now, okay, to be honest with you, in most cases, public companies, because the fact that they are listed, everything over there is structured in a systematic way. If you want to know the market value, for example, of a public company, you don't need anyone to give you the information. You go on the securities exchange and you get it from there. They can use it, but theirs mostly it is market forces of demand and what? And supply. But for private companies, whose shares are not traded, how are you going to know if you do not compute? But how him computing this ratio, he was trying to show you the solvency of this company, the average as far as its value is concerned. Do you understand? Do you know a company can be of a high value? It can have a lot of debts, but its values are what? Are high, that they can cover it up. But this one said, I do not want to use the old figures. I really want to know your current value versus the liabilities you have. It will tell me whether you are solvent or you are going in a ditch. You understand? And X4 sales over total assets. This one, actually, they want to know if you are making enough sales. If you are using your assets enough to make the sales. That's what they want to know. Now, he said that I know you're going to compute those ratios, but you may be confused of how to use them. So he gave us parameters of how to use these ratios. So let's say how to interpret the z-score. How to interpret the z-score, because you're going to compute them and then put them in his what? Formula to get the z. But now, how do you interpret when you get the z? How to interpret the z-score? How do you interpret this z-score? You know, you have to be careful with these questions that the examiner randomly comes up with and they have not been setting them. The guy can actually bring it back, jokingly. More so when he sees that most people have failed it. He will know now that people don't understand that area. And it's a very simple area. It's a very simple, you cannot fail this, by the way. These are questions you have to get all your marks. Now, he said that we are going to have a z-score range. A z-score range And then we are going to have the interpretation here. Interpretation. So how does it work? Now, if you compute your Z, if your Z is greater than 2.99, if your Z is greater than 2.99, you are in a safe zone. In fact, that's how you interpret, that's how you advise them. They are in a safe zone. It means that there is 0 chances of bankruptcy. Remember, who uses this banks when they are going to give you, when they are scoring you? They want to give you what? Money. Or investors, if they want to know whether you will be bankrupt or not. So if your Z is greater than 2.99, you are in a safe zone. Otherwise, that company is good, they can invest in it. They are not even, there are 0 chances of them running bankrupt. But now, if your answer of Z is between 1.81, it does not go below 1.81, but it does not exceed 2.99. This zone is called a gray zone. It's called a gray zone. And a gray zone means that there is some uncertainty on the financial position of the company. Or you're uncertain of the financial position of the company. So you have to do, if you are a person who is going to, if you're a bank and you're going to lend this person, you have to do further, you dig further into other parameters. Okay? And if your Z is below, if your Z is below 1.81, this zone is called a distress zone. Remember that financial distress we have talked about? What does that a distress zone mean? You are at a higher risk of what? Higher risk of what? Of bankruptcy. By the way, next time, before we compute, we go to this calculation. The question can say part C, and they give it 5 marks. So, Ivan, what does the Outerman score use for? What is its applicability? Where do they use it? They can use it in predicting what? Bankruptcy. Mostly insurance companies and banks and investors. They can use it in credit risk assessment. People that are in loans. They can use it in to check the internal financial health of the company. Or even for investment, what? To know if you can invest in that company or not. They can also use it for in audits and due diligence, and so on and so forth. So there's some of the application of this. But let's see this question. Let's go back to our question. That's all you need to know about this. Now, this question was very clear. They said, using the Outerman Z score, evaluate LDC's risk of bankruptcy from the investor's perspective. From the what? Investor's perspective. And comment on the score obtained for both 2022 and 2023. You cannot get the 10 marks if you don't what? If you don't comment and do what? So these are 2 questions in one. Okay. Let's go to the question now. Lukuri Dairy Company, Uganda Limited, LDCL, is a publicly traded company listed on Uganda Securities Exchange. This company was a stalwart in the dairy industry. For it, we can't see the screen. I think people want to see the question. Okay. Can you see it now? Come again? Okay. I can't hear you. I think your network. Okay, they said they can see it. Good. Now, this company was once a stalwart in the dairy industry for its premium quality products and commitment to sustainability. Currently finds itself in a precarious financial situation. You can mute. If you are not asking a question, you can mute, please. Okay. Now, despite this strong brand reputation, the company is facing significant challenges. I don't know, this gentleman, please mute. What's his name? Morris, please mute. Okay. Okay. Now, despite its strong brand reputation, by the way, as we are reading this, you need to understand, when they put these cases, they don't just put them for familiarity. You actually need to understand the case. The examiner wants to pick that interpretation, whether you understood. This is a client. Now they're telling us their problem. So when we are advising them, we must advise. In fact, me, I advise students, even when you are doing recommendation, at least comment about a name in that scenario. If it was an argument between the finance director and the MD, bring their names. That I think MD Ivan so and so was this and this and this, but according to, like, show the examiner that you are contextualizing, you are advising something you have read. By the way, do you know that they give professional marks even if you have failed on computation, but the examiner sees that you had it, you had the knowledge, they may give you a mark on it. You want to know the examiner, you will be shocked. I'm saying you will be shocked. I don't know if I am part of the people, but you will be shocked, I am telling you. So we are saying that, I'm reading and I'm saying you contextualize the question as we are reading, that despite its strong brand reputation, the company is facing significant challenges that threaten its viability, such as the trade restrictions on export of dairy products to neighboring countries and the more frequent animal products quarantines imposed by the Ministry of Agriculture due to various diseases, such as the foot and mouth disease. These have resulted into a significant decline in sales and operational disruptions, exacerbated by shifting consumer preference towards alternative dairy products, which have resulted in dwindling revenues. In light of these challenges, the board of the directors at the company recognizes the urgent need to address the company's financial distress while staying true to its core values and ethical principles. They understand that any solution must strike a delicate balance between short-term survival tactics and long-term sustainability goals so as to boost investors' confidence in the organization. As such, they have sourced the services of a financial consultant. Listen, a financial what? They have sourced your services, my friend. You are a consultant. These people don't give you names for nothing. Do you know what that means? It is just telling you, give me an answer that suits a title of a what? Of a consultant. Imagine you are Ivan who is marking this paper, and I have called you all the names, consultant, MD, what? Only for you to calculate and leave things with double dashes. For me to do what exactly? You get what I'm saying? They will not mark you, I am telling you. And you know, I always tell people, some of you think that, you know, in accounting, they mark what? They mark entries. Now some of you have that mentality in this paper, that people here mark entries. Here people don't mark entries. Here people mark a decision. They mark a decision, not your entries. Here they assume that you know how to calculate, but you are using this calculation to make a decision. If you have not given it, you would rather give a wrong decision, but you have given a what? Do we understand? I don't want us to follow a trap of how, by the way, I'm telling you, this paper has been registered in lower passes. Not because people don't know. People have the knowledge. You may be shocked, but they don't know how to apply. The knowledge. This is an application paper. That's why they start the basis. Is that okay? So go in that exam knowing that you are not there thinking that they are going to mark your transactions and your calculation. You are not doing them a favor by computing ratios. That's not what they asked you. They wanted you to advise based on those what? We are clear. Let's proceed. Now, they said they have sourced the services of financial consultant to devise a comprehensive strategy. You listen, to navigate through these turbulent times. The appointment consultant's first advice to the company was that the company needs to carry out financial statement analysis to determine their liquidity. Enjoy the question. Enjoy it. Enjoy it. Read it to enjoy the scenario. You get what I'm saying? Don't just read just to answer. Now, they are saying that they want to determine the liquidity, profitability, efficiency, and solvency status as the prospective investors will be interested in them. They have been approached. They have been approached as a specialist in financial management. I think you have been approached. You have been approached as a specialist. You see, he's now calling you different names: consultant, specialist. You have been provided with the following information. They have given you the financial statements for the year ended 31st December 2023 and 2022. Some of you may find people wasting time to read the figures. Operating expenses 9,000 and 7,000. Well, you don't know what you are doing. You will not finish that exam. So, statement of financial position as at 31st December, it has also been given. Maybe when you reach the balance sheet, be careful with it. Understand the items, for example, in the current assets, under current assets. You realize that we have inventory, receivables, and what? And the bank. Note that, and go down in the current liabilities. How many do we have in the current liabilities? Other liabilities and what? Note additional information. The shares of the company are currently trading at a premium of 5%. The minutes I have taken to read this question are the minutes they require you to read it as well. Now we understand they want us to measure the efficiency, profitability, but we don't know yet down. I'm assuming you are reading for the first time. If I'm reading and I say financial distress related, and when I read the scenario, it's about bankruptcy. If I have studied this, I already know that this guy wants me to use this score to analyze this thing. So, using a Altman's score, evaluate the risk of bankruptcy. This is not hard. What do you do first? What do you do first? What do you think we're going to do first?
What are we doing first?
Hello.
Yes, please.
Good evening.
Good evening to you.
Under this question, I think we are going to first
Yes.
talk about the outer money's Z score, a brief explanation. Then we explain the distress zone, the gray zone, and the safe zone, depending on the ratios.
Now, you see, what's your name?
I'm called Charlotte.
Sharon. Now, you see Sharon's response, and her approach is the approach of a prize winner. That's what it takes for, if you have been asking, but these prize winners, what do they do that we don't do? That's what they do. By the way, sometimes even if you don't know, you have to show this guy that you know. You comment more about this and what you are going to use, and the criteria. It just takes 1 or 2 minutes. Don't just rush those things. You have to be commenting. This is not a computation. This is not mathematics. You are a decision maker. That's why they call you a financial what? So these things must flow in a report way. And I think that is the problem that most people do here, is to focus on computing. Computing can only earn you a few marks. It can only earn you what? But it is not going to give you the marks of a consultant. Okay? Now, you do what she said, and then you even state the formula and say that the Z formula is going to be equal to, remind me, 1.2x1 plus 1.4x2. Thank you. 3.3 what?
X3.
Thank you. Plus
0.6.
0.6 x4.
x4 plus
1.0.
x5.
1.0.
x5.
X5.
Yes. Now, in that same question, by the way, avoid giving a formula with letters and you don't define them. You are going to lose 1 mark. You get what I'm saying? When you use letters, symbols, numbers, define them. You come and say, okay, where, I'm assuming we have already talked about it, brief, then if it's one statement, where my X1 is going to be equal to working capital over what? Over total assets. See, you are defining these letters. My X2 is going to be equal to retained earnings over what?
Total assets.
Over total assets. See. And my X3 is going to be equal to earnings before interest and what? And tax over total assets. And then we have X4, which was market value of equity over total liabilities. You are defining these letters. And finally, X5 is sales over total assets. Don't waste a lot of time. You don't have time in an exam. That is 2 minutes. It should be enough for you to write this. You have already, by the way, even before starting here, you have already earned 1 mark for that. 1 or 1.5. If you have never failed by 48 or 49, you may not know what 1 mark means. But if you have failed by that, you know what 1 mark means in this paper. Now, you know what to do. Let's go and compute them and come and do our Z score. So, without wasting time, you're going to have 2023 and 2022. Let's work together. And these are going to be the parameters, or the parameters that you're going to use. Let's start. X1. Of course, we have working capital over total assets. Read for me here the figures of what you know. Working capital is called current assets minus current liabilities. Read me the figures under current assets up here. We have 23 not so. You go to the balance sheet. I don't know if you guys have the question, but I cannot go back and then come back. If you don't have, kindly download or it is 23 plus 16 plus 200 minus, tell me things in the current, I'm just going to squeeze them here. Under current liabilities, this is a minus, I'm just going to squeeze them here. 14,200 plus 19,000. Anything else? Yes, so it's going to be components of current assets minus components of current liabilities. Divide this by total assets. Total assets must be given to you. In 2023, what do we have?
We have 25.
Other part, we have 19,000. You are giving me the answer here. It is 19. Which one? 25. Okay, here it is 25,000 plus 19,000 plus 1180 minus liabilities 45,000 over total assets, which is 101180. I am just waiting for your answers here. You need to get used to the calculator. Speed is also important in an exam. And then what do you have under 2023?
I'm having 0.05. I don't know what others are having.
0.05. Okay. What about under 2022?
0.002.
0.002 to what?
Yes.
What? Just 0.002, or there are some other decimal? Give me 4 decimal places.
Zero 6.
Where?
0.00206.
0.00206. What about here? 0.05 what?
0.0503.
03. Thank you. Now we are done with X what? X1. Isn't this very simple? These are things that don't even have tricks at all. Simple, you do, you go. Compute for X2, which is going to be retained earnings. Retained earnings over total assets. So tell me under 2023, your figure for retained earnings. 20,000 divided by 119,200. What figure do you get?
Evan, may you scroll up a bit?
For food, no. I'm okay. I'm full. Thank you. No, I was there. I moved out just a few minutes ago.
0.1678. 0.167.
All right, people, you will come.
0.1678.
8.
Thank you. Can we have as well for 2022?
As for 2023, I'm having a different figure.
Come again. As for 2021, which one?
The
You mean on X1?
Now the 0.0206. Me, I'm having 0.009.
No.
9?
I don't know if I'm the one
Others, what do
computing
you have?
wrongly.
Someone is saying under 2022.
2022, yes.
They have a different figure on X1.
Yeah, I'm having the same 0.1678.
0.16. No, I mean this gentleman means on X1 under 2022, they seem to have a different figure. This one.
I'm also
Do we
having
have the
maybe the problem is coming from that working capital. The competition of working capital.
Did you use 2500 plus 19 plus 1180 minus 45?
So for the one up, that working capital, me as one, I'm having 100. When
You're
I
having
less the
100?
current, yes, when I less the current assets minus the current liabilities, I'm having 100. Then when I divide by 101.18, 180.
Up there is 180. Did you get 180?
Up where?
On current assets minus current liabilities.
Yes, it's 180. 180 divided by 101,180.
101.
Me, I get minus
You also get a different
0.017 or 0.018, which
okay. I think it is 0.0018.
mine is 0.018.
0.0018. I hope
No,
all
the
have the
zero,
same.
there's only 1 0 after the decimal place point.
There is 10.
Yes, maybe I'm also wrong. I'm not so sure because I'm
There are
dividing
2 zeros.
180.
There are
But
2
you people,
zeros.
but
There
you
are 2
people at
zeros.
this level, we
Let
need
me
to
try it
really
There are 2
again.
understand the
zeros.
calculator.
0.0018.
Let me calculate it again. Let me do it again.
Okay. So for X2, what do we have? Do we have 17180 over
17180.
101,180? And what we have?
I'm having 0.1698.
0.0. You said 0.0 or
No,
0.1?
0.11698.
Yeah, which is the same as 0.018.
That's correct. Even mine.
You round off. Okay, that's good. So let's go to X3. Let's go to X3. X3, which is going to be earnings before interest and tax over total assets. What do we have here in 2023? 12,500 divided by 119,200. And what do we get? 0.10
0.1049.
which is 45, 0.105. Okay. Then we have what we have in 2022.
That is 40,400.
33400 over 101 180.
0.3301.
That is X3. X4 it is market value of equity over total liabilities. Now, I want us to understand how we get the market value. These are the trick, a small trick, but it's also not a trick. You go down and we compute, let's compute the market values. Market value of equity. When you read that question, what do they say about the market values in additional information?
Trading at 5% premium.
They say that the shares of the company are trading at a premium of 5%. Is that okay? If it is trading at a premium of 5%, how do we get the market value per share? The market price of a share will be equal to that value, the per value, plus the what?
It will be equal
The premium.
plus the premium,
Plus the premium.
which is 5% excess of per value.
Yeah, some of you may get the 5% of the per value, which was? The per value is 10,000 in the question. Yes, in the question it is 10,000. So you may get 10,000 plus the 10,000 times 5%. Or you can do it as 10,000 times 1 point what? 0.5.
1.05.
So what value do we get?
That is 10,500.
10,500 like
500.
this?
Yes.
Like this. But
Yeah.
remember, we want a total value. This is a market price of a share. But how many shares do they have? You need to get the number of shares that they have. You know how we get the number of shares? Come again?
Yes.
How are you?
Yes, we know it.
How are you feeling?
Okay, so times how you get the number of shares, you're going to get the total. You're going to get the total equity.
Share capital, divide it by the number
Yes,
of by
equity or
the
share
per
capital.
value.
Share ordinary share capital, which is 20. It is 20. It is 20, and they are carrying how many millions? They are carrying millions. You can divide this by the per value, which is 10,000, to get the number of shares.
2 million shares.
So you have 2 million shares times 105,000. You can carry 6 zeros back if you want. But what do you get? Don't we get 2100? 21?
Yeah.
And remember, it is going to be the same because they did not change. So you go back in your table and do the 21. By the way, they can even tell you it is trading at a discount, so a premium or discount. So 21 divided by what is the figure for total liability?
Hi. You are sleeping already?
What is the figure for total liabilities?
And I'm sure Mal is in the room, right? Mal.
7. I'm sure this was given. Total liabilities. Guys.
Total liabilities.
Yes.
I'm getting 33,200.
For 2023,
It's 73,200.
73,
200.
I went to the guy of
200.
the lamb. We finished the deal. Bye.
What about here? This is 211 over what is the total liabilities in 2022?
Yes.
That is
It's coming on Sunday.
55.
And give me those papers.
It is 55. So get the figures down here. Yes?
The one for 2023, it is 0.2869.
Just carry water now.
Just 1 second. You have what?
0.2869.
He tried as much as possible.
Which is 0.287.
He gave us 16 million.
Then for 2022, it is 0.3818.
18, which is 1. You've seen where we get it from? You've seen it? Okay.
Yes.
Now we need to finalize the number. X5 is
There's no jack.
Sales over total
Jack is
assets.
where? Mandy took it.
Now, the sales, what figure do we have for sales? 32,500 over 119,200.
Najok.
So,
you guys have the jack
what
there?
do we have here?
0.273.
3. And here? 0.298. Is it
0.498.
498, like that?
Yeah.
Yes.
Okay. Now, you have got your figures. What do you think we are going to do next? We are going to get the said score for both years, 2022 and 2020 and 2020.
No.
So let's get
even the
remember the
audit was
parameters and how we make the decision. So for Z Altman score for 2022, we have line to scroll up from X4.
If it sleep tomorrow, it will not taste nice.
Is it an easy number? Very simple.
It's easy. It's hard. When you've been practicing.
When you've been practicing. Okay, so Z is going to be equal to 1.2. Read for me. This is for 2022. Here we got 0. What? 0 for 2022. 1.8 plus 1.4 into 1698 plus 3.3 into 3301 plus 0.6 into 0.382 plus 1.0 into
0.498.
0.498. Now, just give me an answer for Z.
What do we have?
Still calculating.
Okay. 2.
I'm having 2.056.
2.056. 2.0, some say 0.56. Now, as my students, in the first year of 2022, what do you advise? What do you think? Is this company under what we call a gray? It is under a distress? Where does it belong with this figure?
The gray zone.
That is under a gray zone.
Because remember, we said if Z is greater than 2.99, you are in a safe what? But if it it falls between 1.81 and 2.99, it's in the gray zone. They are what? They are uncertain of the financial what? Position
of the company.
at least in 2022. Let's see if things improved in 2023. So you compute the Z Outerman score for 2023. Let's work together. Z is equal to 1.2 times. Was this 0.05? 03 plus 1.4 into 0.1, 0.104, sure, 87.
No, it was 0.16.
It was 0.16.
0.1678.
78 plus 3.3 into, I think this was 0.1 what?
0.105.
105 plus 0.6 into
0.2869.
0.27 plus
28.
1. Okay, 28. Small, round off difference. What about here in 1? Into 1 we had
0.273.
273. Excellent. Thank you so much. Now, what is our Z?
0.287.
Come again.
1.086.
1.087 from 2. What does that indicate?
Financial distress.
Have they moved from the gray zone to the distress? Yes. That's what the examiner wanted you to say. They are moving from a gray zone to a distress zone. What happens in a distress zone, by the way? There are problems there. Salaries are not paid, suppliers are not
There
paid,
is no-
things that so
There are
how
employee turnover.
exactly. So remember the question was asking you, don't forget you need to go back to the question to know if you have answered it. Use automated score to evaluate the risk of bankruptcy from the investor's perspective. You notice that the score reduced from 2022 to 2023. It declined below the threshold. This is associated with the high risk of bankruptcy. So this company is at a high what? Yes. You of course you are writing, my friend. You write the advice. If you don't, you are not earning a mark. You may give you small marks on computation, but you earn in box because you wanted to know. Investors' perspective: can they invest? Can they invest? This is a company that is going in a ditch. They cannot invest in such a company. What should you write? What do you think you should write? No, but you need to practice writing your own recommendation. At least for you, you've seen what the examiner wanted. So what do you think you should write? Of course, you comment about your results and the trend they are taking. You start by saying that yours in 2022 is this, whereas that of 2023 is this. Then you comment that it is declining by what? Then what that decline, what does it indicate? From you say from the Z interpretation of this query, it is coming from the gray zone, a zone of uncertainty to a zone of a distress. It's not viable for investors to invest in such a company. But I'm not saying exactly write those words, but just practice how to make recommendations. So that is it. I would have given people a break of a few minutes, but no, we no longer have that time. If maybe we were studying, we would have had the time of a break. Let's just push at least one number. In the cost of capital, they gave you percentages instead of money. That is the simplest if they give you percentages because they have already given you the proportion. Yes, someone is asking Ivan, what if the question just gives the percentages? But you know cost of capital. Weighted average cost of capital is equal to, let's say, cost of equity times the value of equity over the value of the pool. What do you think this thing is measuring? A percentage of equity in a pool, but they have already given it to you. So do you need to compute it? It is the simplest now. You just have to multiply by the cost of what? Equity, because they have done that for you. So if it comes and they have not given you values, but rather percentages, that is the easiest. They have saved you energy. And it even happens mostly in when the question wants you to compute the marginal cost of capital, when they have already given you the percentages. There is a confusion between there is no confusion between CAMDIV and the XDIV at all. At all. Just to know when you are getting the cost of equity, you use an XDIV. X what? Market price per share XDIV. So if the examiner has given you a market price per share CAMDIV, then less it from the current dividend and get the XDIV. Period. You get the market price per share XDIV, CAMDIV minus the current dividend. Now, that is what you are going to use in your computation for cost of equity. There is no confusion at all. So now, What about computation for convertible bonds, sir? A computation for a convertible bond is also very simple. Very simple. You have two things. You have to decide initially, should I convert this or I should not? I should wait to maturity. How? By weighing on the value of the bond if you convert it versus if you wait. Now, if you're going to wait to maturity and you're not going to convert, you just get the normal present value, but your redemption value is going to be either par or what has been given to you in the question. If you are going to convert it, you do the same valuation, present value. But what makes the difference is that your redemption value becomes your conversion value. They will tell you that they are going to exchange these shares, the debt for these shares at this value. So you get that value. It's going to now become your redemption. There is no confusion there. But I'm going to have a session for people to ask questions. Let's first at least do one number, then we leave time for people to ask questions and where they feel they did not understand, so that we can interpret. Now, this number, of course, had a number of ratio analysis. That one doesn't miss. You have to be aware. And I think, yes. When they give you a ratio analysis with industrial averages, it means they want you to compute the ratios as per the industrial average. However, when it comes to inventory ratios, you have to do an average. Yes. Average means opening of last year plus closing divided by what? 2. If you are finding, for example, inventory days, you use average inventory. If you are given in industrial what? Averages. If not, then you compute it the normal way. Finding something on convertible bonds. I think I have just said something on convertible bonds. I don't know which one exactly. Do you, first of all, wait, do you guys want us to spend this time in this, or we can first do at least one number and we now open up a session where people can ask what they did understand? By the way, let's first, I think, let us first do at least one number. This number is becoming common as well. Let us first do one number, then I'm going to open up a session for people to ask questions. We can do this number of inventory management. By the way, don't forget that at least in every paper, there will be one number on working capital. When I say working capital, either it is on cash. Cash means that they bring the models, cash management models, Mira-all model, or Bamul model, or they can bring a computation on them, or they're going to bring a cash budget and little theory or no treasury management, centralized management. That if they do not bring that, they are going to bring inventory. But you see, last time he brought inventory, but he likes receivables so much. Actually, he has set more receivables ever since the beginning than, yes. So some people are saying, why are you saying he? Oh, it's a she. Anyway, receivables are more common than the other. They have never brought payables, but receivables is always 50-50 with what? With the theory. Sometimes they may ask you what are factors that they consider before giving you a loan. You know the 5 C's, the character, the collateral, the capacity. the capacity, the collateral, the capital, the condition. Yes. And they may even ask you to advise on what strategies management can do to ensure that they manage their receivables properly. If they have been having issues with people paying. By the way, when they ask you strategies, if the question was asking you to give an advice on clients that we are not paying, don't rush to saying that I should send them an agency notice or a notice to sue them. You also need business. You need to be practical. You start small by sending them reminders. Please, Bambi, pay our what? Our money. It is due. If they fail, engage their boss. If the accountant has refused, engage their boss. Our money has been due for some time. When are you paying us? If they refuse, limit on how you give them credit. If they have been taking more goods on credit, limit the credit. If they still don't pay, don't now stop giving them credit. If they don't still pay, engage a mediator. Probably you have someone of their bosses you know, engage them. Why are you people not paying us? If they still don't pay, you can consider inviting a third party to collect, like invoice discount it or factor it. If they still don't pay, you can now start to send them notice to sue them. But don't rush to say, I will send them a notice to sue. My friend, if you are the finance manager, you are going to chase away all your what? All your clients. But that question can come. Strategies that you can implement to ensure that management does manage this properly. They may even ask you, okay, the number of receivables is always 50-50. But let's do this number. And we leave some time to ask questions. Let's do the number of, it is question, I think question 2. There's this question 2, by the way, you also have to be aware of the questions of the people that I started with here at Capital College. Is one of the topics that we did comprehensively was the topic of time value of money. Because you see, we noted that people don't give this topic enough time. Yet it is a very big topic. In fact, everything else comes from that topic, time value of money. Now you see the examiner is bringing it. It was question 2. Things of retirement schemes, annuities, perpetuities. How do you compute an annuity due? How do you compute there's ordinary annuity? How do you compute fair values of an annuity due or fair values of an ordinary annuity? Present value of an annuity due, present value of ordinary annuity. That is the topic we did comprehensively. And if you feel like you need to capture a few things about it, you can contact these guys and they give you recordings of those classes that we did on time value of money. It is a very, very good topic. And these days, at least they bring a number in 1 or 2 sittings. Now you see this number. It is a very simple number to someone who understood time value of what? Of money. This question what? Question 2. It's a number you can do actually in 15 minutes and you are done. Yes, also be careful when they tell you 15 minutes is for reading, please use them for reading. When I say reading, read through the required for each number so that you know if you can do. You know you can fail a paper because you chose the wrong numbers. Don't be excited in that paper. However easy the number may look, don't let your excitement make you choose the wrong what? Yes. Okay, let's do question 3. Let's try to do question 3 and we see what can we get from it. Then we invite questions for people to ask questions. This number is the same paper. I think let me share with you the screen for you to see. Let me hope you are seeing the question.
Yes, sir.
Good. Now, what do they want you to do? What do they want you to do? They are saying, with the relevant calculations, advise the board of the company on one, the net cost or saving on adopting an EOQ model in inventory management. 7 marks. 2, the cost stroke benefit of introducing an early settlement discount of 1% to commercial customers. 4 marks. And the cost or benefit of accepting an early settlement discount of 2% from BIPL. And finally, explain to the board the components of cash flow planning within an organization. All right, we go and read and we see what this question has to offer for us. We are doing question 3 of August 2025. Bulamu Poultry Farmers Limited is a renowned company in the poultry industry as the leading supplier of chicken within Uganda. The company has been grappling with poor management of working capital, which has adversely affected its liquidity and profitability positions. Its main suppliers threatened to stop supplies unless some of the invoices that are overdue are cleared. The board of directors of the company got concerned and requested for answers from management. But during the recent board meeting, management informed the board that the company had challenges in management of inventory and receivables. They went ahead to inform the meeting that they have put in place some strategies to address the working capital challenges, including adopting economic order quantity model, introduction of an early settlement discount for the payments within 30 days, and accepting an early settlement discount for invoices settled within 30 days. Following management's presentation, the board tasked the chief finance officer to evaluate the proposed strategies. The CFO decided to delegate the assignment to you, and you have been provided with the following information. The company's annual demand for chicken. This is annual demand. You can write. Let me first read because now I can't write. I need first to go back. But you note that the annual demand for chicken is 1.2 million bags. With the new inventory orders placed monthly, each order costs 500,000 Uganda shillings. Additionally, there is a cost associated with holding inventory. That is holding cost. The other one is ordering cost. Now, holding cost amounts to 10,000 shillings per unit per year. To ensure smooth operations, the company maintains the buffer inventory, which is equal to 40% of 1 month's sale. Last year, the company had sales of 15 billion. All sales were on 30 days credit to commercial customers, and most customers did not pay on time. Extracts from the company's most recent statement of financial position relating to working capital are as follows. You have receivables of almost 2.4 billion, you can imagine. And the payables are 2.2, they are almost equal to each other. And you have an overdraft of 3 billion. By the way, do you know sometimes why companies get overdraft? Poor management of what?
of cash and working capital, but we shall see the impact. Because you see, we assume that if you give people money, goods on credit, and they take days, you must finance your operations via what? Working capital. Because otherwise, where are you going to get money from? Because you have to wait for these guys for 45 days to pay you. So how within 45 days, the staff are not going to eat lunch? You know what I'm saying? So you have to finance this by working capital. In order to encourage customers to pay on time, management introduced an early settlement discount of 1% for payment within 30 days. We're enticing people to pay on time. Because you see, these guys have been having a problem. They were not paid. Receivables are high. But they are saying in order to encourage customers to pay, they have introduced some new measures. An early settlement discount of 1% for payment within 30 days, while increasing its normal credit period to 45 days. They are even going to increase their credit period from 30 to 45 days. It is expected that on average, 50% of customers will take the discount and pay within 30 days. 30% of customers will pay after 45 days. And 20% of customers will pay after 60 days. Additionally, this company actually purchased chicken from Bugwe Poultry International Limited at 8,000 per bag, with a credit term of 60 days. Remember, we are analyzing both payables and what? Receivables. The company also offers an early settlement discount, this company of Bugwe, of 2% for invoices settled within 30 days. To finance the working capital needs, the company utilizes an overdraft facility whose average cost is 15% per what? Per year. It is essential to note that the company operates on a basis of 365 days in each year. And sales occur evenly throughout the what? The year. Sales occur evenly throughout the year. Let's answer part A with relevant calculations. Advise the board of BPFL on the net cost or saving on adopting EOQ model in inventory management. Of course, they are going to be done in parts. They first asked us on EOQ. Let's go and do our computation. We are doing question 3 of August 2025. You guys are seeing my screen?
Yes.
Yes.
Okay. Now, let's go and do our number. Now, I am going to teach you how to answer these questions like a professional. Because the examiner expects you to answer like this is not mathematics where you're just going to write figures and compute. You must be, your figures must be speaking. Okay? I told you, you need to first make a summary, and then I'm assuming you have already made your summary. While you are reading, you make a summary. Okay? Do you remember when they said the annual demand is what? But it is annual. So annual demand is 1.2 million what?
Birds.
million birds. But the current order policy is that orders are placed what? Monthly.
Are placed monthly.
Yes, the current order policy is that orders
Are
are
placed
placed
monthly.
monthly. You do this
We
when you are
divide.
reading the question. By the way, you will not have time to read the question 2 times. You read as you are summarizing, just that I couldn't do that. So you divide. It's going to
Divide
be
by
1 point.
12.
Yes, 1.2 million divided by 12. And what are you going to have monthly? A 100,000 birds. But they are birds, it's not money. And in this question, ladies and gentlemen, what is the ordering cost? What is the cost of ordering per order?
500,000.
It is shillings 500,000 per order. It's just a summary, not started doing the question. What about the holding cost per unit per year?
$10,000.
It is shillings 10,000. And it is per bird per year. They have also told us that they have a buffer inventory. They have a buffer inventory. Buffer means that they have a minimum, they have a safety minimum inventory. That if your stock goes at that level, things are bad. It's like you saying, I cannot go in, for me to go to town, I must have a minimum of 20,000. In case I knock someone is X, I can be able to pay them. So, what did the question say about the buffer inventory? It's going to be 40% of what?
Of the month
Sales.
Of one month is sales. By the way, these questions are very easy if you understand English. Because there is no logic, like it's just the language. And you will see we answer what they want. So 1 month is sale is, what is 1 month is sale?
100,000.
100,000. So times 40%. We have 40,000 birds. And we even had the sales for last year. We had the sales for last year, which amounted to, didn't they tell us 15 billion?
15 billion.
We shall see where to use it from. And we have trade receivables. We have trade receivables of 2.466 billion or million. Here you are summarizing as you are doing the question, and that's how we do these long questions. You're not going to read as like you are reading a novel and then you come back and you think you're going to understand it. First time, summarize as you read, so that now when you're computing, you just go back to your summary and then get what you want. So we have trade payables. Trade payables are 2220 million. But don't forget we have an overdraft cost of 15% per what? Per annum. We have an overdraft of 15% per annum per year. Yes, but also we can buy these birds. We are not working in the sector alone. We can buy these birds at what price? At what price? Yes, they told us that the purchase price of these birds is 8,000 shillings, 8,000 per bird. Can you, if we bought 1.2 million birds, what do you think would be the purchase cost for those birds? If you bought 2 million, 1.2, what do you think is the purchase cost?
9.6.
It's going to be 1.2 times 8,000.
By the way, purchase cost is the same as demand. Yeah? This is equal to demand. It is 1.2
times 8,000
times 8,000, which is
9.6.
9.6 billion or million. And then don't forget the assumption that a year will have 365 days. And then and this is what you do in an exam. You tell him, please, all the interest percentages. I'm breaking, sorry. Can you hear me now? Am I still breaking? Guys?
Yeah. Okay.
You're
Okay,
clear.
now?
You're getting you.
Oh, sorry, I think it was network. So you put it to him that all interest percentage are per annum. By the way, and this I should get used when you are in an exam. You are not just, this is not mathematics. Here you must be telling a story. Your calculations must be telling a what? That even when someone reads the calculation, they know. In fact, you do it in a step-by-step basis, and that should apply to all.
Excuse me, Ivan.
Yes.
There are instances when the
Yes.
examiner can tell you that the year is a 360 days.
Yes.
So it means that we use 360, not 365.
Exactly.
Okay.
It's like you doing a number of capital budgeting and they tell you tax. In short, we should assume the examiner does it. No, by the way, that is it. And I always teach my students on level 3. And that is the same reason why people fail on level 3. You see, they have lower percentages of passing compared to other papers. The examiner assumes does not know. You people fail to understand. In fact, even when you put a jargon or a finance term, you must explain it in your report. So I'm going to use profitability, PI. What do you mean PI? For you, you assume the examiner knows when you say profitability index is PI. They don't know. You cannot say, so I'm going to use NPV. What is NPV? National what? You get what I'm saying? You must define it. The examiner assumes he behaves like he does not know he's a client. You tell a client who has never gone to school and he says, so I'm going to advise you according to NPV. So what do you mean exactly? They don't know. That's why I'm saying in this paper, you need to assume that you are a consultant. You are advising someone who does not know. When you introduce a jargon, a finance jargon, you must explain it. You get what I'm saying? I use the PI. What do you mean PI? You think the examiner knows PI because you know he knows. He does not know. And I have to avoid using short forms that you have not explained. When you use a short form, explain it. When you use a formula, explain it. These are small things that make people fail this paper. Because people think with this paper, you need to have a lot of knowledge for you to pass it. You just need to know what exactly the examiner wants. By the way, most people that pass this paper are students that are strategic. They exactly know what they know how to make the examiner happy. Someone doesn't even know the disadvantages of something, but he starts very well. He comments, he writes about it, along the way. For example, the examiner may ask, give the advantage of the disadvantage of, let's say, payback period. And then you say, it does not take into consideration time value of money. So what? You can go ahead and say, payback period does not take into consideration the time value of money. However, if it is incorporated in the formula, it could prove to be worth a while. Like you can advise on a disadvantage. You get what I'm saying? You have to be a little bit professional. Like you need to be as if you were actually a consultant advising. Don't be so rigid. Yes, please.
I lost you after you had talked about buffer stock. That's why I'm asking you to scroll back a bit.
Sorry, we got buffer was 40% of 1 month sale, which was 100,000 times 40%. We got 40,000 bags. And the last year's sale, it was just a summary. We have not started computing. It's a summary. If you have the questions, we are summarizing the question. So I was just telling you that the things you need to pass this paper are more than just what? Knowledge. But anyway, let's first finish the question. We shall come back to that. Now, by the way, these things I am telling you, and you need to understand me. I have interacted with a person, or I don't know that person, but just know, whoever is going to mark you, I have had a conversation. And these are the same conversations that we tell you. But for you, you take them for granted.
Excuse me, Ivan. What are we saying? 40% of 100,000?
Because the question said the buffer is going to be 40% of 1 month's sale, and 1 month's sale is the 100,000. Remember, up there we got it by dividing by 12 because they told us the annual demand is 1.2 million birds. But the policy of this company.
So the demand is the sales. The demand is the same as the sales.
Yes.
Yeah, I thought we were going to use the one
Use
of
the
last
what?
year, and we get a month sold at 1,250.
You thought we were going to use what? Which one? You mean the 15
billion and then divide it by 12 months.
Don't forget EOQ is specifically helping you to manage inventory, not values. That formula is helping you to manage your birds, not the figure that you have that has gone in your account. You understand?
Yes.
Exactly. So you cannot use figures here. You have to use the birds or the units because you are managing units. So
okay, thank
let's
you. I
first
get it
finish
now.
this number. Come again. Let's finish this number, then we shall come back to our exam approach. Anyway, the first question wanted you to compute what did they want you to compute?
Told us the net cost of saving on adopting EOQ mode in inventory management.
Yes.
The net cost of saving.
Thank you. By the way, you must be organized. Some of you think you just compute. You don't just compute. Come and tell that person because you have summarized that. I am answering A, part 1, and then the heading of what you are answering, and it is EOQ, that is the net cost versus the saving from adopting EOQ. Be organized, be orderly. So he's going to know, oh, this person is answering part A. Then for you come and answer part B, then put part A where part. No one has that time, by the way. I am telling you, when people are marking, they don't have that time. If you are actually disorganized, when they tell you be organized and ordered, they mean it. I know what they do when they see that you're disorganized. I know.
Excuse me, they mean it, but time.
Time, let me tell you, you have
Time
how
is
many
on
you are
our
going to
side.
mark. You are going to mark how many scripts? You are going to mark 400 scripts and you are few. You know what it means to mark an exam, eh? Now, if I am opening your page, the first thing I want to look at, first of all, I don't want to waste a lot of time. If I open your page, I need to know which questions you did, First of all, when they tell you write the questions you have attempted, that one you take it for granted, but it can cost you. So I open and I say, okay, which question are you attempting first? Question 1. But for you, you have put question 1 here, but I have to go back. I open where there is question 1, there is question 2. First of all, I'm going to be annoyed. I will tell you that. Don't think bias does not apply when people are marking you. I'm going to be annoyed, first of all. Then I am going to spend my time to check where your question is. After checking it, then you have written part 1, then you faster, then you cancel, then you went to part. I'm going to be annoyed 2 times. I am going to, even if I'm going to be lenient a bit, I will not. I will be a parent. Anyway, but you get what I'm saying. You get what I'm saying. Yes, because some of you you think the examiner is going to have mercy. There is nothing. The name is not there. What I'm seeing is your number. So I am going to mark you with professionalism. However, if someone is organized, they give you energy. If this person is organized, I may be a little bit lenient. Maybe they have tried. Okay, let me give the mark. Then you, with your handwriting, you are like a doctor. Who is going to? I am straining to read the letters. So don't think that bias does not apply when someone is marking you. These are humans, not machines. Let's do the number. It's just a warning. Now, let's compute the EOQ. You know very well. Step 1, you write. Be organized. Step 1. Step 1. Compute. Tell the examiner, be talking. Compute EOQ. Put the formula. Talk it. Formula of EOQ is 2 demand ordering cost times the holding cost. Talk it. My friend, when you talk it, if you have time, you can actually tell him D stands for annual demand, S stands for this, H stands for this. Proceed. Now plug in the numbers in the formula. You already have, you don't say that I've already summarized. Now the examiner will go back in your summary. No, say, oh, because when you are answering, your mind should know the person who's going to mark you. You don't know if someone is going to mark you after they have had lunch and they are tired already. So you say, okay, my demand is 1.2 million baht. Then my S is going to stand for ordering, which is 500,000, and my H is going to stand for 10,000 shillings, sir. Now this one is making me happy. They go back, they put their formula EOQ, then they feed in the what? They feed in. So it's easy for me to see. I'm going to be seeing, oh, okay, 2 times, oh, annual demand is 1.2. Oh, that's nice. And 500,000. Okay, over 10,000. It should take you a minute to get your economic order quantity. Come again. It is what? Per watt. 500,000 is per watt. And the formula says per watt. No. Per order. Per order. The S is cost per watt. Per order. It does not matter how many orders you're going to make, but what do you incur every time you make an order? Do you get what I'm saying? It is per watt, not per unit. It is not ordering cost per unit. No, it is ordering cost per what? Per order.
Per order.
So how many birds are we going to get? Don't come and tell us 10,000.4. Is there a point bird? You need to be when you are writing these things. Sometimes you need to be logical. Of course, you know they are dealing with birds. You can't if they are in the points, you can't say 102.4560. Really? You get what I'm saying? So how many birds do you have? You round off. That's what I mean. What do we have?
I'm getting 10,000.
10,000.
954.
954. You must speak.
Yeah.
You say, so, thank you so much. You say, so EOQ is 10,954 birds per order. Instead of you are speaking, the calculations are speaking, instead of the current 100,000. You can imagine they have been ordering 100,000. That is wasteful. Instead of what? 10,000. Like you are telling the examiner, yes, I know what I'm doing. Step 2, you compute the current total annual inventory cost. And you go and put it there for him to see. That step 2, I'm going to compute the current total annual inventory cost. Underline. There are two components, the annual ordering and the annual holding. And you tell him that there are two components. Here, there's going to be annual. Yes, please.
May you please scroll up a bit on the EOQ?
Here?
Yes.
You thought? Let's first do and then we compare the thought. Let's first finish, then you see if the thought is still applicable. Okay. So step 2, you compute the current total annual
instead of 100
inventory cost. And we said it is in two components: the annual ordering cost plus the annual holding cost. Okay. Now remember, you're going to first compute with the current orders, because you want to weigh and see with the current orders what is the total cost I am having. With the new EOQ, what total cost am I having and what am I saving? You know what I'm saying? That's how simple it is. So you know you are going to compute ordering cost. Ladies and gentlemen, how do you get the ordering cost? Ordering costs are equal to the number of orders times the ordering cost per what? Per order. How do you get the number of orders? The number of orders are equal to annual demand. Divide by EOQ. Times the ordering cost. What is our annual demand, ladies and gentlemen? 1.2 million birds a year. What is our current, our EOQ?
Order cost per order.
100,000 is what they have been ordering. Sorry, per when they make the order. That was the policy. Because remember, they are making the order month. That was the policy. It means every month, that's what they were what? Ordering. Then times the ordering cost per order, which was 500. It was 500,000. 500,000.
500,000.
Yes.
Still computing that. He's in step. He's computing the total annual cost.
So remember, we need first get what we are going to incur every time we make orders, but what we are going to incur every time we stock a lot, because we want to show this guy that you adopting EOQ has worked for you, because it has saved you this cost that if you had not applied it, you are going to incur it. That's what he wanted you to tell. That's the story that he wants. So what figure do we get? What is the ordering cost? So the ordering cost is
I'm getting 6 million.
6 million shillings. That is what they incur in
Excuse
total.
me, sir.
Yes, you are excused.
So I beg your pardon on why you use that 100 instead of this EOQ we have just calculated.
You see, this question wants you to compare the total cost without EOQ and then the cost with EOQ, because you see that this guy wants you to advise him. He has not yet adopted, but he's saying, if they adopt an EOQ, how is it going to save me? Because as a consultant, you are there to show how this is going to save them. So we are going to first compute without EOQ what would be the total cost that we incurring now. Now with EOQ that they have introduced, because EOQ optimizes the quantity, says don't just buy, use a systematic method or methodology to tell you how much you should buy. That when you buy it, it's going to minimize your total ordering and total holding at the same time. Why are we calling EOQ? Well, okay, why I call it EOQ? First of all, the word EOQ means what? Economic order quantity. It means quantity. As much as I'm calling it EOQ, but that is the quantity that they were having apparently. Maybe I can call it Q, quantity. You get? But just know it represents. Come again?
I was like, I think it's better to call it Q because I may put EOQ and I put the other calculation there down.
Okay, that is good. Okay, call it Q. Call it Q, but just know it is the quantity.
Yeah,
call
it's
it
the
Q.
current order quantity.
Exactly. It's the current order quantity. That's okay. That's fine. Someone saying, where do we put buffer? We haven't. We are still computing. We haven't reached there. So, but now we have the ordering cost. Now let's go and compute the holding cost. Holding, because there are two. Let's compute the holding cost. Now holding cost, and it's going to be holding cost per year, is equal to average inventory. Average inventory over, okay, because it's the same, anyway, inventory over 2. It's the same as average inventory times the holding cost per unit. But remember, for us to get the average inventory levels, the average inventory levels, they are going to be equal to the quantity that we have been having, or that every time we make the order, which is 100,000, divided by 2 plus the buffer of 40,000. The one who was asking, where do we put the buffer? This is where you put it. You put it to get the average inventory level. Average inventory level, when you have a buffer, you add it. So what do we get? What is the average inventory level that we get here? 90,000 birds. So our average inventory level is equal to 90,000 birds. Now you're going to multiply with the holding cost per bird, which is 10,000. It takes you 10,000 shillings to keep a bird.
So does that one mean that we only apply the buffer when we are computing the holding or the average inventory level?
Thank you. We apply it when we are computing the average inventory level. So now it means that your holding cost per year is going to be equal to the 90,000 birds, or which is the average inventory level, times the 10,000, because they told you they incur 10,000 to keep those birds. What do we get? we have got 900 what? 900 million. That's how much
Yeah,
we
that's
incur.
900 million.
Yes, 900 million. So now we can get the total cost without the EOQ. What is the total cost? Of course, you're going to add them. The total current. Yes, please.
So this one, they have given us the minimum inventory levels. What if they give us both, the minimum and the maximum?
What if they give us the minimum and the maximum? Then you're going to have to apply EOQ in other conditions of uncertainty. That's also a different number on its own, where you have lead time. They will even give you lead time. That is EOQ under conditions of uncertainty. But here, there is no uncertainty. We don't have lead time. We assume that lead time is not there. They are constant. Those things are constant. Is that okay?
Yeah.
So we have the other one was 6 million, not so 6 million plus the 900 million. So our average inventory cost without EOQ is equal to 6 million. That's how much they are incurring now with the current system of them not having an EOQ. They just have their system of you buy 100 every month, but you need all of them. They just buy. You get. Now let us compute the EOQ.
Excuse me, sir.
Yes.
On the holding cost, how have you got the 9? Is it 9,009 million?
The 900 million. We got the average inventory level times the cost, the holding cost per bag. How do you get the average inventory level? It is the quantity they were procuring divided by 2. That's average. Plus the buffer stock. Is that okay? Then when you get that average inventory, multiply it with the holding cost per bag, which is 10,000. And you'll have your 900 million as the money you incur to keep these bags.
All right, thank
you. Ivan, excuse me.
Yes, please.
But if I decide to calculate the holding cost differently with the buffer,
But
I
does it
calculate
give you
holding
the
cost.
same? Yes.
It's giving me the same
It gives you
answer.
the same answer? That's okay. That's fine. So long as you arrive at the same answer. There is no specific way of arriving, but so long as you arrive at the same answer.
Okay.
Okay. You were asking, what if you do what? If you want to minimize zeros, you make that assumption there to the examiner. That please I am carrying. By the way, guys, avoid minimizing zeros without telling the examiner. Because when I'm marking and I'm not seeing you putting them up, and I'm not seeing, for example, if I am the one marking, and I'm not seeing commenting anywhere, I am going to assume that I don't know what is this. In fact, when you don't tell me the currency, I don't even know which currency. Are we in Uganda shillings or you are computing in dollars? Those things, by the way, they may make you lose marks. You just put figures and you forget the currency and carry the zeros. They will make you lose marks. Actually, the examiner is right to cancel your number. I have never seen a student who has gone to ask for a remark and they actually end up winning. Because those things, they go back and now say, oh, you didn't even put zeros. Yes. No, in most cases in questions, they will, if they have not stated the currency in the question, don't assume. If they have given it to you and you see they have said shillings, make sure you put it there. And make sure if you're carrying zeros, you indicate it. You show, please, I'm carrying 3 what? Avoid thinking the examiner will obviously know you carried 6 zeros. You can say it. You can say note the draw figures are in millions as a comment so that you don't have to put a million every time you are computing. You make that assumption. Because if you don't, the examiner has the liberty to cancel that question. You have not understood the question.
You see why people fail? Not because they don't know. Yes? Mm. Mm. With the bad. Now, I think you see, you have to be logical as well. Yeah, you can keep the zeros. If I say 1 million bad. Yes, if I have stated it, I say 1 million. Yes, you state it. When you state it, you are avoiding to have to put this every time you are computing. Because if you don't indicate it, this examiner does not know which figures you are dealing with. Someone may be saying 900, but actually they are not millions. They have got the question wrong by mistake. Don't make assumption for the examiner. He assumes he's the dumbest person in the world when they are marking you. Even those things you think it is going to be open to him, he can actually cross it. More so when someone is tired and they are seeing you are busy removing and bringing zeros, nothing, they cancel and move on to another thing. Then you ask yourself, but these people, why are they failing us? They want to eat our money. You just need to do what is expected of you and actually be careful when you're answering. All right. So let's compute, finalize this number in like next 10 minutes. Let's compute step 3, compute EOQ. You're going to compute the total cost anyway with EOQ. EOQ total annual inventory cost. Now you remember EOQ, we got it is 1095 what? Yes. So come and do the same. Start with ordering cost. The ordering cost, remember I said it is equal to demand, the number of orders, number of orders times ordering cost per order. Number of orders are annual demand over EOQ times the ordering cost, which is S. You remember the annual demand here did not change. It is 1.2 million what? Birds. However, EOQ has changed now. We are ordering 10,954 birds times the cost of making the order, which was 500 what? 1,000. So what is the total ordering cost? It is 54 what? You say it's 54 million. 54.77 million. If you don't want to say the word, you can just say million. Like you say that you say the word million. Don't think you're going to put figures and the examiner is going to feel mercy. They will not feel. Get this from me. They will not feel mercy at all. Cast I have computed? No, you have not advised. You will give me some marks. This is not accounting. They will not give you the what? The marks. They mark what the question wanted. If you have not answered it, someone moves on to something else. They don't have time for you. So you have to be very what? Careful. Now, let's get the holding cost. The holding cost, we need to get the average inventory first, which is equal to EOQ divided by 2 plus the buffer, if it is there. If it is not there, you don't put it. We got EOQ already as 10,954 divided by 2 plus the buffer, which we already have 40,000 birds. This is not money, these are in birds. So what is the average inventory that you get here? Average inventory is equal to 45,477 birds. Now you just get the holding cost. Total holding cost is going to be equal to 45,477 birds times the 10,000, which is the cost per bird, holding cost per bird. And what is our total holding cost? 4.77 million. Now get the total, both ordering and holding. It is going to be equal to 509.54. So what is this person saving? By the way, the net saving is what they asked. How much is he saving?
Of course, the annual savings is equal to the 906 minus the 509.54. What do you save? 396. Okay, 396 million. Ladies and gentlemen, here you have to conclude. You have to conclude and say adopting EOQ reduces total inventory related costs by, why don't we add the purchase cost since it's part of the total inventory cost? Now, someone is saying, why don't we add the purchase cost? Let me tell you something. Do you know why we don't add it there? It's not going to change anything. It's constant. It is 8,000, 8,000. Whether what or what, it is the same. So it is going to be meaningless. Now, I said you have to, yes.
I think it depends on the question. The question has told us inventory management, not total inventory cost. Yeah, that's why we are not adding in.
Yeah, that's okay. And by the way, if we are going to add it, you would have seen, the question would have been very clear with that. But here you cannot get 7 marks unless you have concluded. You would say, from your observation, for example, adopting EOQ has, like, it has, you have to be like a consultant. It has, adopting EOQ reduces total cost by 396 million. That's a lot per year. That is very large saving, mainly because of the current policy that keeps very large inventory. Now, the recommendation is implement EOQ and ensure ordering and receiving processes can handle the orders, the number of orders. You have understood that? Can we complete the number, or you are tired?
Let's complete.
Let's just complete anyway. So part 2, they wanted you to find the cost benefit analysis for the 1% early settlement discount to customers. That is part A2. You bring the heading cost stroke benefit of introducing. You have to be orderly a 1% early settlement discount to customers. So you say the objective is to incentivize fast payment, reduce receivables outstanding, and lower working capital. That's the objective of you doing that. But the current position in step 1, the current position apparently, the sales are per year are 15 million, not so? And the trade receivables, actually not 15 million, but 15 billion. They are 15 billion. The receivables we have apparently are 2.466 million. That's a lot. You can even see the margin. Okay. So you are going to do, you know, the same thing we have done with the first one, almost is going to apply on this one as well. Okay. It only changes in a few instances. Okay. So we are going to compute the working capital, or the current amount of money these guys are going to incur at both levels. They told us the receivable, there are people who are going to pay within 30 days. Let's compute and see how much we incur on them as far as working capital is concerned. So those paying Those paying within 30 days, because they said anyway they will get a discount, but we shall see that discount and how we're going to incorporate it. Those paying within 30 days, it's going to be 15 billion times because they said they're going to be what, 50%, not so? 50% will pay within 30 days. 0.5 times the 30 days out of 365 days. To give you the working capital for those, or the amount for those that are going to pay within 30 days. That is 616 million. Then these are the ones who are going to pay within 30 days. They are 50% of them, of the sales, times 30 out of what? Then those paying within 45 days. They are those paying within 45 days. Remember, these ones are not going to get discount. Those who are going to get a discount are the ones who are paying within what? 30 days. So those that are paying in 45 days, it's going to be 15 billion times their 30%. Then times 45 out of 365. So what's the working capital coming out of that? It is 554.8 million. What about those paying within 60 days? So those paying within 60 days, paying in 60 days means it's going to be 15 billion times their 20%, 0.2 times 60 out of 365. You're going to have 493 million, sorry. Now, you're going to add the total cost.
Steven.
Yes.
When we are computing for 30 days, do we less the discount?
Yes. We are going to less we are hold up a bit. We are going to less that discount. You can do it from that point of view, or you can bring it down. Is that okay? But just know we are going to involve the discount in our analysis.
So it means that I can either less it up there or I can less it below here.
Yes, it's okay. It will still give you the same thing. Now, what is the total revised receivables? So the revised receivables are going to be, when you add them in total, what do you get? 1664. 1664. But so you are going to have at this level you can bring this question can be done different, but to give you the same thing. You can bring your discount now, or you can first know the value you have. Then you less the discount on the what? On the value. So what reduction in receivables have we made? So remember, reduction is going to be, the previous one was 2 point what? It was 2,466 billion. But now if we introduce this policy, the receivables are going to reduce to 166 what? 4. And then we shall have a reduction in receivable of almost 936 million. This is money we have received. It's a value. But remember, as a result of this policy, if we give these guys extra days, it is what? When you do 2466 minus 1664, what do you get?
082.
You said it is 802 million. Yes. Now, remember, you allowing these guys to extend these days, and then from 30 to 45 to 60, you are going to have to finance these credit extensions with the working with an overdraft.
So you're going to get this value and reduce it. This is the working capital and reduce it with that overdraft. So that it's going to, you will say, reduction in finance cost. In financing cost. It's going to be this 802 times the 15%. What do you get? It is 140.
320.
120.
0.3.
120.3. It's a reduction. Remember the question wanted us to get the net what? Net benefit. We would have got a benefit of 802, but we financed this thing by an overdraft. So we remove it, and then we have a discount as well. So you go and get the cost of what? Cost of a discount. And the cost of a discount, remember, you remember that not everyone is going to get a discount. Only those that pay within 30 days are going to get a discount. So it's going to be 15 billion times those that pay within 30 days were 50%. Times what is the percentage? It's 1%. It's 1%, not so? So 0.01. So you get the cost of the discount. The discount. You have understood? Not everyone is going to get a what? A discount. Maybe a discount is a cost to you. You would have received that money. You have 75 million. So now you get the net benefit. You're just going to get this 802 minus 120 minus 75. Get the net benefit. And you're done with that number. What do you have?
8607.
I may have 7 points.
Anyway, by the way, it's very interesting how you can analyze this. You see, there was a reduction in reduction in financing, which was 120. But why do you think we have the reduction? By the way, coming to realize, reduction is a benefit. It is a benefit in the sense that if you had continued having that inventory, okay, I want to observe it in the sense of a benefit. You had too much. You had too much in receivable, too much money which was tied up in receivables. Not so. It means that money was seated there doing what? Doing nothing. But here you're going to reduce. Not so. You're going to reduce your receivable by this 802. Then that's a benefit. Now, I think in the version of, you realize this in a version of a benefit actually. Yeah, the 802 is a benefit, but there is a cost of discount for that. You get what I'm saying in that angle? Because let me tell you, when you have a lot of receivables, that is your money. Someone has it, but they are not paying it to you. But there is a reduction. Reduction is actually what? A benefit. Now, you are going to weigh because it means that we would have lost that money if we had left this money to be in receivables. You know that if someone gives me that money now, I can put it on a fixed deposit on this and I get a 15%. Not so. But we have lost it because someone has it. It's an opportunity cost actually. But now it's a saving in a way that we have reduced the what? The receivables. You see how it comes in a benefit to you, Yes. And now, it being a benefit, I would have got that benefit of 120. I can go and invest that money if I have it now. But there is a discount. That me doing that created, of course, this policy of mine created some extensions that instead of people paying, people are going to pay within because I told them, if you bring money now, the reason why this money has come in now, most likely is because you have given them a favorable what? If you pay now, I'm going to give you 1%. 1% means that don't pay me 1% if you pay now. It's a cost to you. Not so? So I can analyze this actual on the incremental benefit and saving by just subtracting 120 and 75. Now what remains is the net benefit I'm getting from this. Is that okay? Can I repeat? Because it's a saving. This money, 800 million. Imagine 800 million when people are not paying you. Someone has your money seated with it. But we are saying if they can pay it to you as a result of your policy, you can get actually 15%. You can put it on a fixed deposit and even get like a 15%. However, as a result of them paying now, there was a cost that those who paid in the first 30 days, you left the 1%, which is a cost to you. So the net benefit is the 120 minus the what? The 75. That's what they wanted in this number. And I think it's and I think let me just finish this one in 1 minute. The one of the purchases, just in 1 minute, because they said that the purchases we were buying 1.2 million bags at 8,000, not so, like 8,000, which time was it? Because they're giving us how many days? 60 days, not so. 60 over, as if it was catering for overdraft. Yes, at first I was looking at it in that perspective, but then I analyzed it in another technical way, and I think it's the right way we analyze it. Because you see, what was the reason for you to compute this? You wanted to know that there is a value in me having a good credit policy in an organization. That if it has saved the 800 million, this money people would have had it. Because you see this scenario in this question, they were not paying, not so? They mentioned that people were not what? Paying. It means, by the way, if people are not paying this money, I'm incurring it as a cost, not so? Because I have to fund my company with this money that is not coming in. Now that I have made a good policy and they have paid, don't you think now it's actually a benefit to me? Don't you think it's a benefit to me now? Because I would be paying that money to finance the operations. But now they are paid, but it came at a what? At a cost. Because you had to entice them that I will give you 1% if you pay early. So I have to remove that. Don't you think it's the best way of analyzing it? Yes. Why are we removing the what? Someone said that analysis is fine. You said why are we removing the 15%? Which one? No, it's a reduction. You see, it's not a cost. I don't want you to see it as a cost. Let me explain again. This is not a cost. You had people, you had sold two goods, but you were crying that these people are not paying you. They have your money, they are not paying you. Said, but if I introduce a policy and these guys pay me, because if they don't pay, it means they have your money. But if someone has your money, how are you financing your operations? Yeah, we are getting an overdraft. But if they pay that money, are you still going to get the overdraft? Isn't that a saving to you? Because it's reduced the receivables by 800 million. It means I'm going to have that money now. That actually it's like a benefit that I would have been paying that money in financing the overdraft. But now they have paid it to me, so it's a benefit. Not so. However, I told them as a way, I will excuse 1%. Whoever pays within that what? That's a cost now. So you see that we use incremental. Some of you have done cost management, incremental contribution. versus incremental cost. You get what I'm saying? And it's a better analysis to analyze it in that angle. And the same thing is going to happen, that these guys were giving us, but remember, these are now suppliers. These are suppliers. It's you who's what? Who's buying. So they were giving me, I bought 1.2 million at 8,000 times 60 over 365. What value we paid out as purchases was 1.578. These are million. But this is what I paid out. But these guys told us that they are going to give us, don't they give us a discount? They give us a discount, not so? Of 2% if we pay in 30 days. Not so? But remember, we are the ones paying now. And you need to know a discount here benefits you or it doesn't. You get it? The other one, it was a cost. Now it has to be a benefit to us. So it means I can go and say, okay, what do I get if I pay within 30 days? Times 8,000 times 0.98, that's the discount. Times 30 out of 365. So what am I getting if I pay? So it gives me 77 million. 773 million. You see that my payables are going to reduce. My payables are going to reduce from, imagine, with the airports that they have brought. Now they're also making sure I pay. So my payables are going to reduce from 1.578 to now 773 million. There is a reduction of almost 804 million in payables. But is this a good thing to me, or it is good for them? Now, you can say now increase in finance cost, because now if you are paying those guys now, don't you think you are going to borrow? Don't you think to pay them? So it means now this is going to be a problem or a payment for you on your side. And you say that increase in financing cost, the other one was a decrease. This one is an increase in financing cost. Increase in financing cost is going to be equal to the 804 that we have got times the 0.15, the 15%, which is the 120.7 million. But I have a value of a discount. They gave me a discount. Yes, I'm going to incur that, but they gave me a what? Yes. So the value of a discount, because that's the reason why I have paid them, I must see that there is a value of a discount. The value of a discount is equal to the 1.2 million bahts times the 8,000, sorry, times the 0.02. What is the value of my discount? 192 million, is it? Now, you think I'm going to compare two things. I'm going to compare the value of this discount that I'm getting from them versus the cost, the increase in financing cost. Don't you think I have a net value of in this? Don't you think I'm getting 192, but I'm incurring 120 to pay them now? I have a 71 million. That's how you are supposed to answer this question. And you advise. That's all. So
Mr. Ivan.
Yes.
As for this figure, me am having, is it 9.4?
Of what?
Okay, as in when you get to the 1.2 million times the price times the discount, I'm
the
getting
discount is 0.02.
I'm
You're
getting
getting
9.4. 9.4.
1.2 times 8,000 times
Now the new price is 7,840.
I'm getting 192.
Okay.
When you have 1 point, yes.
I thought that this discount is going to reduce our price, not so?
Now, I want you to understand something. This question had two elements. It had where you were actually the one selling, and it had when you were the one what? Purchasing. Now you need to know, if you are the one selling, and I'm asking you, does a discount benefit you or it benefits your client?
Benefits the client.
Now, if you are the one buying, does it benefit you or your supplier?
It benefits me because I'm the one buying.
Exactly, and that is what happened. The reason why we paid them early, because we saw this discount was more beneficial. So we said, okay, we are getting 192. We would have paid this money, by the way. We would have paid this 192. So we are okay to actually borrow to finance this. Because when we borrow, we are going to incur 100 and what? And 20, but the discount is 192. We have a value. We have a value. This thing is worth a while. It's viable. Do you understand how you understand a question and answer it in a very advisory way and not just relying on computations with no substance in what you are advising? And that's how they do this, and that's how they pass this paper. Any questions, guys? Before we go, I want to thank everyone, by the way, who has attended the Pro Bono. Some of you who study from here and those who don't, you are welcome, and we are happy to have you tonight. Yes, please. August what? They had to use mouth what on which question and what was the topic? Mouth period. It means that they were not paying in annual. Mouth period means that they were paying in more, maybe semi-annual. When you read that question, I think they were paying quarterly. Yes. Yes, but you just need to know where there is R, you divide by M. Where there is M, you include a M. NM. I think you may have missed that first topic of ours. When you go to the solutions, I am not a person who likes CPS solutions, but don't rely on them 100% because most of them are wrong grammar. What really you cannot rely on that to conclude on something. You just need to understand the topic and how they compute something. Don't overrely on them. But when they say multi-period, it means they are not paying annually. They are paying in more than one. So they are multi-period, either semi or quarterly or even monthly. In the formula of getting the value? Now, remember, how do we get the value of an inflation? No, let me tell you, the value of a financial instrument is the present value of its future cash flows. You remember in that formula there is a R, there is a power N, where there is N, multiply with M. Where there is a R, divide it by M, and you have the number. The value of any financial instrument is the present value of its future cash flow. They wanted you to get the present value. Guys, any questions before we sign out? Do we have anyone to pray for us, by the way? Do you have anyone to pray for us before? Then maybe I can let some people go. Then I can address that. Someone, please. We should have someone online, a Samaritan, to pray for us so that we can pass this exam with the flying colors. Can we have someone to pray for us?
I'm suggesting we pick from the physical class.
I beg your pardon?
I'm suggesting we pick from the physical class.
You are suggesting because why I'm picking from why? Why do you speak for others online? you don't want to play, you guys.
No, we like, but I believe most of them maybe they are offline currently. So I'm just
Most of them are
suggesting.
offline.
They may be online, but they are offline.
That is how people are going to miss out on heaven.
No, there is someone who said, who told me maybe she wants to pray for us. It is okay in case there is someone who wants to volunteer.
All right. If there's someone, please, it's just a simple prayer, then we close it off.
Let us pray. Heavenly Father, we thank you for the gift of life. We thank you for this day. We thank you for this session that we have had. Father, as we prepare to sit the exams, we call upon your Holy Spirit to be with us, to be able to help us to remember whatever we have learned, whatever they have taught us, and whatever we are trying to read and that we have read. Father, we pray that you help us and give us speed in writing these exams. Father, above all, we pray that you help us to pass these exams. And as we are going to sleep, Lord, we pray that you make us have a blessed night and be able to wake up tomorrow to continue with the work that is pleasing on your side. We pray all this through Christ our Lord. Amen.
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 All right. Thank you so much for coming. Have a blessed night.
Amen. You too.
Thank you.
And success to you all. Success to you all.
Thank you.
Thank you.
Amen.
Thank you so much.